talk about the business in a moment. Let's talk about these markets first. This is interesting that we're on both sides of the Atlantic. We're talking about deficit concerns, public finances. Of course, we know the fiscal deficit in the U.S. is a looming issue on politics, on the election. It's a similar story here in Europe. How do you play it? How do you invest in that?
Yeah, so and it's a question that obviously a lot of our clients and a lot of our investors have been asking, and there is some concern around the growth and the speed of the growth in deficits that we've seen globally. But, you know, investors continue to find value in bonds, particularly at these yield levels. We continue to see interest in both in U.S. debt, and our conversations as well point to significant interest in European debt from the clients that we speak with. And I think that really highlights for us the focus and the reason why we're looking at getting involved in the European market is that it is a big draw for a number of investors, and there is real interest from our investor base for us to bring the kind of liquidity that we brought to the U.S. market over to the European markets.
I'm glad you brought up the liquidity story, because that's one of the concerns of why people, one, go to the U.S. Treasury market in the first place and why they don't go to Europe in the second place. Talk to us about why that's even an attractive proposition at the moment when, again, we're talking about real weakness on this continent.
Well, for us, the idea is how do we bring liquidity to that market, right? How do we aid the market structure? How do we aid the market resiliency? And I think it's important to recognize that the European market has functioned quite well over the last few years, right? We've went through a very aggressive hiking cycle, and the market had no functioning issues. So for us, it's about how can we bring a differentiated type of liquidity, a tech-focused liquidity, to a market that maybe hasn't had that approach before.
And so you're expanding into European rates, Michael, which is really interesting. And you're doing some of that in Paris, I think. Talk to us about that Paris hub. It seems to be attracting, well, it's attracted you, it's attracted others, and some people draw a link with Brexit. But you tell me about what attracts you to Paris. Yeah,
so we're quite excited about our Paris office. We're going to be running our European rates trading operation and sales operation out of Paris. And it's a fantastic talent pool, a very technical talent pool, and we've been able to find resources, whether it's across sales, trading, or technology, that really quite additive to our business.
That's interesting. I was going to ask, are you having to take talent from London to Paris? But no, doesn't sound like it on a big scale.
We've made a few hires from London as well, but Paris in of itself is a quite deep talent pool.
And what are the plans around gilts?
So right now, we've done our first trade in sterling IRS. We'll be fully live in that space over the next month or so. And then I think if your ambition is to be relevant and a material play in the space, which for us it is, it's inevitable that you trade gilts. So get sterling IRS up and running, and then focus on gilts.
I think European politics, we're seeing a lot of volatility at the moment. Do you think it changes the attitude of businesses like you to where you do business in Europe, the types of governments that we're potentially going to be seeing formed? There's been a lot of... The Macron government has made a big push to attract a lot of people into Paris. There's a bit of volatility in French politics right now.
Yeah, the one thing I would say is that the European Union overall seems to be quite focused on its capital markets, right? So we're seeing a revitalization of a true capital markets union, a focus on making markets more efficient, a focus on improving liquidity, improving transparency. And I think politics are always a feature of markets and always something that have to be navigated. But certainly the underpinnings of the European Union, the underpinnings of the European financial system are quite strong.
Politics is starting to insert itself in a way that it hasn't until recently. You're seeing it with what we've seen in European government bonds, OATs, yesterday. The gilt market probably is feeling a little bit more kind of comfortable with what is happening on the political front over here, but we've seen emerging market politics kind of upending markets in quite a significant way. We're all kind of building up to November, though. We're all trying to figure out kind of how markets are going to react and price in what we see in terms of US politics. Is that a conversation you're having now? Is that a trade that you would think about putting on now? Steepeners are super popular now, but they're not taking off. Is that a trade that takes off after the election? I'm wondering whether this is something that you are actively pursuing at the moment, or is it something that you wait until September, October before you start putting those trades on?
Yeah, I think you bring up an interesting point about the curve and the level of inversion that we've had for some time. I do think, even if you take politics aside, if you look at the setup in the economy now, you have inflation that continues to run above target. And we think that we have a Fed that's going to be very responsive to any weakening in the labor market. Those two things together, independent of politics, we think favor more term premium, favor a steeper curve. So maybe the political dynamic adds an additional tailwind, but separate from it, the macro setup for it does seem positive.
Are there liquidity concerns in the U.S. bond market right now, given the auction narrative that we're talking about, perhaps less demand coming out of China, Japan, et cetera, married with the fear of that kind of debt ceiling in January 2025? How liquid is the most liquid market in the world?
At the moment, it's quite liquid.
Too liquid?
And I would say I don't think a market can be too liquid. I would say that we see significant foreign demand still for the U.S. Treasury market. That continues to be an important story and an important source of demand. And when we look at it, there are, of course, some concerns that exist in the market, but there has been a number of efforts. Well, I think to your point, can supply overwhelm the market? Are there issues with liquidity? But we've seen a number of steps being taken to improve market functioning. So a focus on an increase in transparency, a focus on an increase in central clearing. These things are all very good for market structure and really aid the functioning of the market over the longer term.
Michael, can't let you go without asking you about the very near term and markets and conversations with clients, what they're focused on. Clearly, we get data out of the US on CPI tomorrow. We get the FOMC decision, and some people are predicting we could see volatility in all kinds of markets as a result of those two things coming so closely together. What are conversations with clients like around that subject?
Yeah, so I think when we look at the inflation data in particular, there's a feeling that the volatility around those prints going forward is maybe going to come down. I think for tomorrow, the focus really will be on the FOMC, and in particular, what does the dot plot show for the number of expected cuts for the rest of this year? That number has obviously come down materially over the course of this year, and the market's split between, I think, somewhere between 1 and 2 cuts. So there'll be a little bit of a reaction, whatever the outcome.
How big a pinch of salt would you take when it comes to the 25 dots? The Fed's, all of our predicting capabilities have been severely tested this year.
I think you take a very big pinch of salt with anything relating to 2025 predictions. The data has confounded many people. The cycle has not evolved the way we would have thought. Yeah. It's a very different cycle than what we're used to. And I think the market recognizes that if we're talking about the 25 dot, for example, it's so data dependent. There's so much evolution that can happen to that prediction over time that it's weighted certainly less, I think, than it would have been in the past.
In terms of, so how are you thinking about the kind of the way that the arithmetic works? If we get 2 this year, do I assume that I'm getting a cycle, or is this just a mid-cycle kind of adjustment? Do I assume that I'm going into a full-blown kind of cutting cycle here, and there are going to be more that follow? Essentially, this is the debate that we're having at the ECB right now, and I'm just, what is your kind of current thinking about how many we get in total? Is it a cycle? Yeah. What makes a cycle?
Yeah. Well, the ECB made sure to stress that it wasn't the beginning of an easing cycle. They clearly want to retain optionality, and I think that's going to be the major theme out of central banks, is that we will adjust, we will respond to the data, but we want to maintain optionality. We don't want the market to get ahead of us. We don't want the market to maybe ease financial conditions in a way that's not really beneficial. So I suspect that we're never say never, but it's going to be difficult to get back to the zero lower bound. I don't think that's where we end up this cycle. I think we're talking about a cycle that ultimately looks like 200 basis points worth of easing and probably a bit more spread out than what we've been used to over the last 10 or 15 years.
A final question to you on the reason you're in town, of course, and that is that expansion into Europe. One of the things I've noticed in this part of the world during my time here is that there is a delay in terms of cross-border transactions. Things aren't cleared as quickly as they are in the American markets. How long before some of those cross-border transactions that even politicians across Europe are trying to make work faster gets to the level that Citadel has created in the States?
Yeah, and I think that's a good point that you raise, and one of the main impetuses for us getting into this market is obviously providing liquidity to our clients, improving their day-to-day experience, but also where we can to push market efficiency and to push the market in a way that's beneficial for all those involved. So that's what we're focused on, and that's what we're focused on delivering.
Do you have a timeline for that?
No timeline. I think head down, get to work, and see where we end up.